It's not to say the economy is dead and dying, but the headline number is absolutely being influenced by this massive noise and policy shock to the import situation. We actually saw, at least on the first reading, a reduction in investment. Many of the categories were rather stable for the quarter. But all to say is the reading in and of itself is probably not as optimistic and to be cheered about as one might think.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart. Welcome you here back for the end of the month recap that our partners do for us at New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. I'm joined as usual by lead partners John Lodra and Mike Presson. You see them with me on this channel every week, but as we've started doing a couple of months ago, we like to give these boys a chance to give kind of a pull back a little bit, give us a full recap of what's happened over the month and what's going on in terms of their outlook of the markets and any changes that they're making to their portfolio strategy. So John and Mike, thanks so much for joining us today. John, you prepared some slides, so I think I want to start with you here, but just to sort of set the table. Stocks have continued their rally. We've had one of the longest rallies in the S&P on record. And the day here we're speaking, we've had two quite positive reports come out. We had the GDP report come out, came out at 3.0%, substantially higher than the 2.6% that was expected. Definitely a big change from the negative print we saw in Q1. So quite a strong number here for Q3, at least on the headline, or sorry, Q2, at least on the headline. And they also revised the Q1 loss by they revised it upward a bit. It was still a negative quarter, but not as deeply negative as what the previous prints were. We also saw on the ADP jobs report that came in stronger than expected as well. That came in at I think 104,000 net new jobs. It was up from the 76,000 number that was expected. So about an hour after we finished recording here, gentlemen, we're going to receive the latest release from the Federal Reserve's Open Markets Committee, and then Jerome Powell will come out and speak to give his remarks. Seems extremely unlikely at this point that the Fed is going to do anything other than just hold pat here, given that the economy seems to be doing just fine by these headline numbers. There doesn't seem to be any sort of real weakness the Fed could point to say, hey, this is a reason why we should step in and start cutting. But anyways, I'd love to hear your gentlemen's thoughts on that. So I guess, John, let's start with you. What do you take? I mean, is this kind of the bulls just saying, hey, yeah, everybody, the water's fine. Just jump in the pool and have fun.
Hello, Adam. Great to be with you and your viewers here today as we're just about to end July. As you already pointed out, we have some news today that's pretty noteworthy. But yes, we have seen an historic run in markets here, higher from what felt like a really scary point in April with stocks selling off. We had a technical bear market register in April, and we'll dive into much more of the nuance and context of the stock market rally since then as we go throughout this talk. The punchline though is we've had a very broad-based and very powerful rally. And there's no imminent signs that that's about to suddenly change, but we are seeing some stalling, some tiring, and some extensions of some of the very broad indicators that have fueled much of this rally. So we'll talk about that in depth. Let us talk about some of the headlines that you mentioned, just starting with the GDP. So the first thing we always want to remind folks is the markets and the economy are not necessarily the same thing. There are countless examples in history where markets do things that the economic data suggests they shouldn't, and vice versa. So I always want to claim that. So we always, we're very cognizant of economic readings, which can be very noisy. And to your point, even like GDP numbers, as important as those numbers are, they have by design several release dates. There's the early release, which we got today for the Q2, and then there's like 2 or 3 scheduled revisions to those as data comes through. So they can be very noisy data points just on the headline value. Let me share. I always like to bring pictures into the fold here to put things into context. So this is right off the U.S. Bureau of Economic Analysis. This is the quarterly GDP reports. So you can see 2024 we had steady positive growth, and then Q1 we had this negative print, which the first reading was actually more negative than it was revised to, but still a negative print. And then today we had this surprise to the upside. I think it was might have been 2.3 or 2.6. I forget what the consensus was, but we had a 3% real GDP reading for Q2. Now, there is a lot of noise in this data series, especially this year. And the biggest factor of that noise has been imports, the level of imports. So the negative Q1 print was inordinately influenced by a massive surge in imports. In the GDP calculation, imports are a detractor to GDP, and the reduction of imports is a positive contribution to GDP. And that's what happened, at least on first read here for this latest Q2 number. We had this massive drop off in imports. If you roll back the tapes, people were trying to front run all this tariff news, and imports were off the charts, including imports of gold, for example, but also everyday goods and consumer goods. That has dramatically trailed off to the point where over 5% positive contribution just in the form of a drop off of imports. It's not to say the economy is dead and dying, but the headline number is absolutely being influenced by this massive noise and policy shock to the import situation. We actually saw, at least on the first reading, a reduction in investment. Many of the categories were rather stable for the quarter. But all to say is the reading in and of itself is probably not as optimistic and to be cheered about as one might think. I will say, and we'll get again more into the stock market action. We have seen a notable improvement in some sectors that are classically economically sensitive sectors that have been laggards for much of this year. Things like basic materials, energy, transportation. These are classically economically sensitive sectors, and you don't start to see those rally and pick up relative strength unless there's some, engine of economic robustness there. So that's an encouraging sign. But this all plays out very slowly and deliberately, and we certainly will be watching for the indicators. I'll pause there. We'll want to talk about the interest rate decision today because there is some takeaways. I think even though we don't know for sure what's going to happen, highly unlikely they're going to cut rates. But I'd like to pause there. We can certainly pivot over to the interest rate discussion.
Okay, yeah, I think I want to take it there actually. Just real quick, I should have mentioned this in my intro here. I'm on the road, folks. I've started my travels over the next couple of weeks. So if you're wondering why I'm not in a normal studio, that's why. I'm sitting next to this nice fireplace here, and will quite soon be on my way to Ireland, and you'll probably see some interesting backgrounds there. And I've also prepared a lot of videos to run while I'm gone anyways, folks. So even though I might be in some different locations in a few of them, you should have the same usual stream of videos coming out over the next couple of weeks. We shouldn't skip a beat. All right, yeah. So John, so that's very helpful to know that the Q2 number, this initial Q2 number, we should take with a pretty hefty grain of salt. Which, I mean, there's nothing to suggest the economy, isn't still continuing to grow. It just may not be growing as robust a number as this headline number suggests. And perhaps just as Q1 wasn't quite as bad of a quarter as the headline number seems, because everybody was front running. Now everybody's selling the inventory that they took in and not importing as much. So, there's a little bit of distortion to the upside this time around. So the truth is probably lies somewhere in the middle. Now, there are some other indicators out there, I'm sure we'll talk about a few of them, that suggest the economy actually is still on a slowing trajectory. But right now, there's nothing that seems to be blinking, big warning signs, either from the economic growth standpoint or from the jobs standpoint. So to today's FOMC release, which again, the audience will know by the time this video comes out. But I'm assuming, like me, you think it's highly unlikely that the Fed is going to really do anything material here at this point.
Yeah, that's right, Adam. And more to the point, virtually nobody thinks the Fed is going to do anything. This is a chart, and this is a chart, a time series chart, showing the probability of the market's perception or read on the Fed's move on rates. So first, a little background. The current target policy rate is 4.25 to 4.5. That's what this is. Those are in basis points. That's why it's not 4.25, but 425. So that's the current level, right? And this shows the market's assumed probability that the rates will be at this level at these various policy meeting dates. So I've highlighted the July meeting, which is today, as we've already talked about. What you see here is that there is essentially almost 100% market implied probability that the Fed will stay at the current level, i.e., they won't cut. Now, I think what's most noteworthy about this chart is the dramatic change that we've seen in just the last handful of months. Even back in April, early April, when Liberation Day and all the tariff shock and market soft, the market was pricing in a near zero probability that by July the rates would not have been cut. And we've had a massive change in that. And we'll talk about this later, I hope, but we think a large portion of that change has been an absolute 180 in fiscal policy and policy signaling. You had a great conversation with Darius Dale and Luke Roman the other evening that touched upon this. I think Darius uses the framework of paradigm B versus paradigm C. We came into this year with the administration talking a lot about fiscal austerity, cut costs, let the market collapse or reprice. We need some pain to solve the longer term fiscal issue. Um, Almost to the day with the negative reaction of Liberation Day tariff announcements, there's been an abrupt shift. The bond market freaked out basically in April. And what have we seen since then? Very little in the way of cost cuts. One big beautiful bill, which most objective observers would say didn't really do anything to solve the fiscal situation. In fact, it cemented a continued kicking in the can. There has been some positives out of these tariff news in the sense that there is revenue coming in. We'll see if how long that revenue stays in play versus affecting global trade. But the point being is that the markets, especially interest rate markets, are pricing in a dramatic policy shift, and that we think has implications for how one should be invested long term. We'll cover that, I'm sure, later. But right now, it'd be highly unexpected to see the Fed drop rates. And despite all the bullion by President Trump that Jay Powell's too late or should cut, there is absolutely no economic justification in our very strong view for any kind of cut right now or any kind of meaningful cut.
Okay. Um, yeah, I mean, some people I interview would say that they think that the economic trajectory, is to the downside, and the Fed might want to get ahead of that. But that aside, there's nothing here that's saying the Fed should be worried to step in any sort of rescue element here. And of course, the Fed is still saying, hey, we want to see what the ultimate inflationary impacts of these tariffs are before we start taking down rates, because we want to make sure that inflation is good and dead, right?
Yeah, quarter basis point cut sometime soon for like insurance. Maybe that makes, but not the 300 basis points that very publicly has been, demanded of the Fed, right? That we think would absolutely unleash market chaos in a lot of different ways, especially the bond market.
Yeah. And look, the audience will know the results of this, the Fed release by the time this video goes out. But do you have any strong feelings one way or the other about whether the Fed will make any changes to QT?
I don't have a strong opinion there. I honestly haven't read any kind of signaling there that would suggest there's any changes. I do know that back to this policy shift, there's been very notable shift in at least telegraphed intentions of funding federal government, through heavy reliance on short-term bills versus longer-term, you know, uh, coupon-paying bonds. You know, again, 4 or 5 months ago, Treasury Secretary Bessent was really critical of Janet Yellen's reliance on the bills market
Mhm.
as being fiscally irresponsible. Well, that seems like that's exactly where we're going under his current telegraphing.
Yeah, it is interesting, and you could have the discussion. Does Besant just feel sort of trapped based on Yellen's decisions, and he's just stuck financing at the short end of the curve until longer term rates come down, or is it a policy pivot on his part? I don't think so yet, but time will tell. Yeah, and on the QT side. Again, we'll find out. And obviously, QT, folks, means quantitative tightening, the Fed reducing its balance sheet rather than increasing its balance sheet, which it was increasing its balance sheet most years after the global financial crisis until recently. That is one way that if the Fed had some concerns but didn't want to bring down rates yet, it could basically continue to slow down or stop QT altogether as a way to sort of ease a little bit of its tightening of the economy, of economic conditions, right, John?
Yeah, that's right. I mean, anytime you play with the supply and demand of that longer end of the bond curve, which that would do, it should have some impact, however small or large, on those longer term rates.
Okay. And then last on the Fed, then Mike, we're coming to you. Um, Interestingly, there's kind of been some, leaks in the media over the past couple of days that this will not, whatever today's decision is, it's probably not going to be a unanimous decision amongst the FOMC committee. And it sounds like maybe there will be two governors this time around that may dissent with Fed Chair Jerome Powell's decision. And I guess what would be notable about that is I think that might be the first time since the 90s where there were two dissenting votes on the committee. Do you take anything from that, or is that just
Yeah.
posturing people who want to
So,
get potentially appointed as the next Fed chair?
so I was aware. I think Waller is one that has been very vocal about his intention to dissent. I'm not sure of the other one. And some of the jawboning that I saw Waller come out with was, actually a little bit concerning. Basically he was talking about, I think, and I apologize if I'm misattributing, but I think he was talking about he sees a more partnership role. That sounds innocuous enough, a partnership role between Treasury and Fed. That sounds innocuous enough, but you know, the Fed is supposed to be independent. Everybody knows the Fed is a political creature, just like every other political entity. But this almost says the quiet part out loud. It's debatable, but the global economy, the global markets have always celebrated at least some degree of independence of monetary policy by our Fed and the spending engine of Congress and the Treasury. And when we hear things like partnership, we hear things like laying tracks for yield curve control and further intervention in bond markets is unnatural. And that's why we think the future ahead, and we'll talk about it, things like precious metals, commodities. We think the long, slow train wreck of debasement and devaluation of fiat currencies is more or less baked into the cake with these kinds of developments.
Okay. All right. And by the way, it's Waller and Bowman were the two who are expected to dissent. And again, folks will know whether they did or not when this video comes out. All right, Mike, heading over to you here. Feel free to add on to anything that John has already mentioned here, but some other recent developments, which I think many would say are positive, has been the announcement of trade deals. So we had a trade deal announced with Japan a little over a week ago. And then earlier this week, we had a trade deal with the EU announced, right? And look, I get, whenever I mention these, people say, hey, nothing's been signed. And, there's a lot of details that still need to be ironed out. Absolutely. But this definitely is positive forward momentum. And, there have been, public press conferences and handshakes. I mean, everybody seems at least, publicly, verbally committed to making these deals happen. So obviously the Trump administration is counting these as wins. And, the numbers are pretty impressive in terms of the size of these trade deals and the amount of investment that's going to be coming into the U.S. as a result of these, and the fact that tariff revenues will be coming in, filling the Treasury's coffers. So if they were to be deployed as currently being sold to us, hard not to think that these are actually going to be pretty positive for the U.S. economy. Not today, but a year, several years from now. Curious to hear what you guys, your interpretation of this, and what you think the short-term and longer-term impacts of them may be.
It's interesting to see because the market reaction's been somewhat subdued, Adam. I would say it's certainly tilted towards bullish. Seems like President Trump's strategy is to come in and upset, a meeting, come in and flip the table over, get everyone upset, and then everything after that is a positive upside surprise. It's essentially what's happening. Just earlier this week, there was a trade deal announced with Japan. I'll show the chart really quickly just so you can see the Japan ETF. This is what happened as it's coming up. Japan's a big move. It was like a 4% move. And so that's a massive move. This is the daily chart of the Japan ETF. Now it's since come back and it's right back to where it was. So you might say that literally nothing happened. But there's a lot of examples like this where there's, reactions that are somewhat given back. So, but that's the way we look at it, is that the market has had subdued reactions and on average it's been more positive than not. And so it's almost like this market wants to be bullish. The participants want to be bullish. You can almost imagine that we could get a squeeze or a melt up in this market. Certainly seems like that's what's needed here to finally wash out this bullish undertone that's existed for so many years. And if that happens, you can almost imagine that there's some major trade deal that's announced that causes the market to get even more euphoric, and that finally uses the energy up. But Donald Trump has found out really hard. The whole taco trade was born back in April, May timeframe. Yeah, people are starting to figure out that Trump wants economic growth. He wants more than anything. I think he wants positive market action. And so therefore, I don't really think the tariffs are a major deal right now. I think the market's been in a bullish uptrend for a lot of years, and it's all been about money printing, and just basically buy the dip mantra. And I think we're entering that end stage. We'll see within months or years, and it could very well be trade deal news that's a catalyst to create that big up move. That could be the sell of the news reaction. Because don't forget, we're dealing with a market that's at least three times normal valuations and has been there for so long that we kind of forget that we're living during this regime. But that's what's going on.
So a couple things. One, post Liberation Day markets, bottomed out. Everybody, or sorry, shouldn't say everybody, but the headlines were full of concerns that global trade was getting completely disrupted. A lot of people thought that Trump's approach was ham-fisted, crazy. A lot of people were looking at the numbers that were on that big poster board that he brought out and were shocked because they were expecting somewhere in the 20% range, and
Hmm.
many of them were way higher than that. And everybody thought, okay, Trump's driving all of our allies away from us and probably into the arms of China and whatever. So basically, just a tremendous amount of uncertainty there. And I'm not saying good or bad. I'm just saying a lot of that uncertainty is being removed as these trade deals are being struck, right? People are saying, all right, you know what? It's not as bad as we all feared when we first saw that big poster board. Our allies aren't abandoning us. They are coming to the table and working out on these deals with us. If you look at the deals that have been struck, we've struck deals with the UK, with the Japan and the EU, and India. I think we've announced like a term sheet or something like that with them that's being worked on to get to an actual trade agreement. And if and when that deal gets struck, and if you believe the headlines, it sounds like that's probably going to happen relatively soon. We will have, the other four largest economies in the world tied up in these trade deals, ex-China, right? So, A, this is removing uncertainty. B, it's probably putting, more wins in the column for the U.S. that okay, these are all good for the U.S. The U.S. is getting, the type of terms it wants. And I've got to imagine, and I'm no geopolitical analyst, but I've got to imagine this is putting more and more pressure on China to do a deal with the U.S. And Mike, you said, maybe the markets need some last big trade deal to have that blow off top, right? And I really the only candidate I can see out there for that type of goosing would be a trade deal with China. But it seems like, I think the theory that some, including myself, put out there back around Liberation Day is the reason why Trump was kind of pushing all countries all at once was to try to get as many countries as possible to strike a deal. and as part of the terms of that deal saying, hey, look, we'll come to a different trade negotiation. You're going to make some gives, but you're going to get some gets from us. But one of the key things we're going to be asking for is that when it comes to China on trade, you're on Team America. So the fact that we're striking these deals, I've got to think is making China begin to realize, all right, the more that we try to resist this, the more isolated we're going to get on the world trade stage. Again, I'm no geopolitical analyst. I could totally be wrong here, but I'm curious your thoughts on that, Mike.
Yeah, I mean, I'm not certainly am not a geopolitical analyst either. I've got to just come out and say that. I would say that and we at New Harbor are more technicians, follow data. Certainly, we're familiar with what's going on in the world, but we are also very familiar with what's going on in the bigger picture, the fourth turning that we're in. And I know we keep mentioning that, but I don't think that you can overstate just how important the cycle that we're in matters. The cycle that we're in matters, and because we're in a climaxing time within the next few years. And so I don't know. My best guess, and it's just a guess, is that we're going to get some major positive news that's going to cause some FOMO reaction. It's going to cause people to pile into a market that's ridiculously overvalued already, and that's going to basically what causes the top. And we've been really early in calling a top, and I know that we have to be public about that because we've been saying that here for years, that the market has been in a bubble for a long time. And just look at it. Each and every little pullback along the way has been more vertical. April, we saw a 21% pullback in the S&P, and boom, it went right to new highs again. So I don't know. It's a dangerous place. If you accept the fact that we're in a fourth turning, that's what I think we are in, then you know that we're at in a time period of maximum risk, maximum effort, and it's a crisis/climactic time. And so within this fourth turning, the things that we're still waiting for that have not happened are the two last pieces of it, the crisis and the climax. The crisis will almost certainly happen when the market crashes, tops and crashes. We will commence the crisis. You'll see falling stock market prices. You'll see falling real estate prices. Unemployment will go up. And then that will likely generate the largest response we've seen to date. And I think the dot plot that what John was talking about earlier with the Fed, being at 3.5% out to the end of 26 and 27, I think we take the under on that. I think that the Fed's going to have to go way back, maybe back towards zero as this crisis kicks off. And then ultimately the climax of this cycle that we're in should be a few years out. And during that time, that will be a good time to buy assets, a good time to buy stocks, but that's maybe 3 to 5 years out. So there is a lot of faith based in that projection at this time because, literally, I can show you some valuation charts that shows you that we should be at around 1,800 or 2,000 on the S&P to get fair returns. And we've been so elevated so permanently that it really feels different this time to everybody. And so that's my best answer to something that I just can't answer in terms of geopolitically, what could be the catalyst, what exactly that path looks like. I envision over the next year, maybe by the end of this year, we get some news that causes FOMO, and that causes us to top out, followed by a couple of years of crisis, lower prices, and huge stimulus again by the Federal Reserve over the next bunch of years. But ultimately, that faith, I think, is going to be lost in the Federal Reserve's ability to keep doing this forever, and that is going to be a difficult time, a difficult few years, and we hope to help people through it.
All right. So, of course, the key question in all this, right, Mike, which is kind of a noble, right, but is when, right? When is this going to happen? As you said, you guys have been expecting it to arrive sooner, but you have been out there actively, investing capital. You guys didn't just go all to, T-bills and gold bricks, and have just been sitting on that ever since. You're playing the market while it's still in an uptrend. So I want to tie this conversation to a video that's going to come out in a couple of days after this one does, that I just recorded with Michael Howell, right? And he's the fellow who really zeroes in on liquidity. And he tracks global liquidity cycles, and he has a lot of really compelling data that shows the correlation between those liquidity cycles and market performance. And kind of the punchline of his latest data is He sees markets still have a positive impulse likely ahead of them for the rest of this year. So, Mike, that could be, they catch a nice bid on some positive, surprise like you're thinking they might. But that impulse will start declining as we approach the peak of the liquidity cycle, and then the liquidity cycle will peak and then start rolling over. And so, he thinks, barring any, uh, brand new systemic change, odds are pretty likely that 2006, 2007 is where we really start riding the downside of this. And Mike, that kind of jives with, kind of your gut that you were just sharing a little bit earlier. So, again, key thing here is when do you know to actually stop playing the game, start getting more defensive, et cetera. John mentioned Darius Dale earlier on. Darius Dale is a huge student of the fourth turning. He worked really closely with Neil Howe, one of the co-authors of that book. But Darius models right now tell him to be long, right? So, a big part of this game is okay, even if we're worried about this sort of Damocles above us, and we know the thread's going to break at some point in time, we're not served necessarily by just sitting out of the game entirely, because this could go on for a lot longer than we think, as it has. But we got to be really vigilant. We got to be very active, right? And if we're going to be long and try to catch the remaining part of the upcycle, we just got to make sure that we're not caught by surprise as things start to turn. So I know that that's a challenge that you guys have as capital managers. So anyways, Mike, I just wanted to kind of share that additional context, but that's kind of the game you guys are playing, right? Which is you got to trade the markets you have right now. They're in an upcycle. The data that John and I just went through, yes, there's some cracks in it, but it's pretty decent economic data right now. It's pretty decent jobs data. The wheels aren't coming off right now as far as we can see. And so therefore, you want to have some long exposure to this market.
Yeah, I mean we are exposed to this market. We've got 45% stocks. We have a underweighted position, and we have had for many years, really at this point, several years now, an underweighted stock position. So you have to just kind of accept that you might underperform in straight up markets. That's part of the cost of being cautious. But yes, you're absolutely right. All the indicators, for the most part, are still pointing north. They're still in the green zone. Some of our indicators are showing some short-term concern, but the trend is up. The indicators are saying up. You just mentioned Darius's model. His model is saying up. So everyone's forced to play the game. It's absolutely true. So you're forced to play the game and dance near the exit. That famous saying, we're dancing, but near the exits. But don't believe anybody that says they can get out of that exit unscathed. Don't even believe in your own ability to take stops without emotion. It takes a lifetime of experience to do that. And even then, it's not perfect. I don't think we would tell anybody that we could say, you know what, we're going to get out and not give back anything. What we say to everybody is we're trying to make good, decent returns. We'd be happy with 5 to 10% net returns in this environment because we have lower risk exposure and not give back much on the turn. Okay, but notice I didn't say give back nothing. We'll probably give back something. If we're lucky, we won't, but we're not going to get negative signals until the market's lower, right? So, and I think that everyone that you've mentioned, including Darius, would admit that. So that's what we're doing. We're hoping to not give back much of anything on the turn. But yeah, right now we're forced to play the game. We're making good returns. Gold and silver and miners are really helping out our portfolio this year and last. So we've got some really good returns under our belt, but we are careful. And as I mentioned earlier, our indicators are just starting to roll over just a little bit in aggregate. And this is a science and an art, right? So it's not like you're sitting at a light and it's going to go from red to green or green to red. It's not like that. There's all these different shades of, oh, I'm not sure in between. But the light is just starting to go from green to slightly yellow here. And so we're doing some very, very minor hedging slash conservative tactics, like we're starting to add covered calls to some of our positions. That'll bring more income into the account. It'll give us a partial hedge if we get a pullback. Wouldn't be surprised to see a pullback of a few percent here. Maybe surprisingly. We've got some really big earnings this week. I know these will be out already by the time your video shows, but Tonight on Wednesday, there's Meta and Microsoft. Tomorrow on Thursday, there's Amazon. That could change short-term movement. So, but even if we get a little pullback, I think the market probably needs that big push higher, like I talked about, to really put an end to this. But so overall, it's a long answer, I know. You got to play the game. We're going to try not to give much back. Individuals, by and large, are completely unprepared psychologically for what's coming. They're, for the most part, in aggregate, buy and hold at this point because it's worked for 20 years. So anyone watching this that's buy and hold and nearly fully invested, 80%, 100% stocks, one thing you can do is just get yourself down to a level of stocks that you can sit with for the duration. Don't underestimate how dangerous this market can be. I'd say get down to 30 or 40% equities if you can, at least. I'd say 30% would be the target here if you're passive. That way you can sit through whatever comes in the next couple of years, not panic, and you can even get more aggressive when the time is right. And so just tune into our videos every week, and many of the different managers that Adam has on, and we'll all be talking about what we're doing.
All right. Thanks, Mike. Look, John, coming over to you. So something Mike just said is that some of your indicators are starting to move from green to yellow, and that's causing you guys to start upping your risk management here. I think it was last week we talked where I was asking you about this, and you said we actually haven't. You guys use hedges a lot, but you were at kind of a rarish moment where you didn't really have any hedges on the portfolio. Sounds like you're actually starting to get back into that stage now.
Yeah, exactly right. We just in the last handful of days, we've sold calls on two of our core sector positions that have had very strong runs. As Mike mentioned, that's a way to bring income into the account and provide in one light a buffer against some downside moves if we should get that, while still retaining some upside. So yes, we are starting to pay attention and adhere to the yellow signals that are starting to emerge, right? I wanted to share, speaking to kind of some of these extremes, there's some really interesting stuff that you can look at in the market behavior this year. And this I thought would be really helpful. This is a chart that shows two broad ETFs, and this is not an endorsement or recommendation for either of these, but you see the blue line is the S&P 500 low volatility ETF. These are stocks, low volatility, kind of stable, steady as they go kind of stocks. And there's screens that S&P uses to constitute that index. And then the other one is the S&P 500 high beta, high risk, high reward, you might say, kind of stocks. And we talked about the tale of two cities this year, pre and post Liberation Day, both in terms of market behavior, but also policy communication. And what you see here is, at the low point, right after in the freak out to Liberation Day tariff news, we had this high beta, kind of slice that was down almost 25% on the year to date, right? Whereas the low volatility, was very stable in this first part of that phase. It was only down a couple of percent at that time, year to date. Look what's happened since. We've had this massive, massive run of these high volatility, high beta type stocks, and kind of a ho hum kind of participation from some of these more traditional, kind of safe stocks, if you will. And we can look at this. This is some great work that was done by a data service that we use called Nasdaq's Dorsey Wright, and they look at the monthly returns for high. If you break up in the quintiles by volatility, standard deviation, and beta, you can see the same kind of thing right through the Liberation Day. The green bars, which are the high volatility, high beta, really got suffered relative to the low volatility, low beta, and the exact opposite. What does that mean? Practically speaking, it means take chips off the table. We've got a very powerful but kind of speculative FOMO type of run here. And you can't time these things perfectly, but it's for real people, which are the folks we serve, not folks trying to post returns up on CNBC. This is an invitation to get book some gains. Defense. Tighten up your defenses. How do we do that? Our mechanism for inviting lower volatility is to make volatility our friend through hedging, through selling down exposure. We already talked about we're about 45% in stocks, but also being in sectors that are are showing relative strength. You can be underweight and be in certain sectors that are performing well. Like we haven't had much exposure to healthcare or traditional energy stocks, for example, this year. It's two of the most lagging sectors in the whole landscape. We have been noticing some slight improvement in the energy sector, for example, but it's been a dog on a year-to-date basis. And these are not light switch indicators, but they're systematic tools we can use to tilt even an underweight allocation to equities to the areas of the market that are outperforming. We're happy. We've delivered, S&P like returns for clients this year with much less volatility, and no victory lapping here. It's just about where we go from here for sure. And we'll just make sure we stay vigilant in adhering to our signals.
Okay, well, thanks. That's really helpful. Do me a favor, John. Pull up that first chart you had shown with the high volatility stocks versus the low volatility stocks. And I just want to point out one thing for viewers here, which is you got to be careful when the animal spirits are really running like they are right now, right? So if you're holding more of those high beta ETFs or high beta securities, you're loving life right now, right? You're feeling like a genius. You're saying, look, I'm up, 17% this year. It feels great. I'm not going to deny that. But just go back to mid-June, right? Back in mid-June, you would have had the same annual return year to date as the low volatility securities, but you would have lost an awful lot more sleep along the way, right? So back in mid-June, you probably would have said, you know what, I wish I hadn't been so in these high high beta instruments this year, because man, I got so many gray hairs and ulcers, during March and April, and man, if I had just played it safe, I would have performed the same as people who were in this, sleepy, stable, low volatility thing, right? And of course, the T-bill investors could have said, well, hey, I did just about as well as you, and I slept like a rock. I took on no risk. So I just want to underscore here that at the end of the game, it is all about how much return you're getting for the risk that you're taking on. And again, like I said, it can really be a siren song when things start going your way, that, oh, well, my riskier approach was great and I was smart to do it. It feels that way exactly up until the point that something else happens in the market, and your returns start to come back into line with those of the safer people, and you start kicking yourself. And I'm not saying don't take risk in your portfolio. I'm just trying to add consistency to the drum that we've been mentioning on this channel a lot, which is the most important thing you can do as an investor is to get really crystal clear on what your investing goals are, what milestones you want to hit by what time frame, and then do the backwards math from that, saying, okay, what return do I need to get from here to there? And in a lot of cases, you're not going to need to get a market average return, meaning you can have a safe, steady way to get to your goals in the time you want to get to them without posing yourself or exposing yourself to the vagaries of all that volatility, right? And John, as you've said, mathematically, oftentimes the safer approach is the best approach, because once you add volatility into the mix there, with some of the setbacks that happen, especially if you're older in life, you just may not have time to ever recover from those. So anyways, you're nodding as I'm saying this, but I know this is a very important point, and I know risk management is really at the core of everything you guys do at New Harbor. So anyways, I'll let you comment on this, then we'll go back to Mike to wrap up on precious metals.
Emphatic yes, Adam. I'll fully agree with all what you just said.
Okay. And I guess if I can be instructive, maybe even deliberately instructive on this, is folks, if you aren't crystal clear right now on what your goals are and what your timeframes are, then talk to your financial advisor and have that conversation. Or if you have a financial plan but you haven't updated it in a couple of years, update it now. And if you don't have one, if you don't have your goals defined, if you don't have a financial plan in place, use this video as a real kick in the pants to say, okay, I got to make that a short-term priority. All right, Mike, coming back over to you. Let's wrap up here on both the precious metals and some of the activity here in Bitcoin. Precious metals have still performed strongly this year, although this has probably been one of their weaker weeks in a while. Silver is correcting pretty hard even on the day that we're talking, but the cryptos still have been benefiting really well from all of this. And of course, I think it's becoming clear that they're risk-on assets on steroids. So I wonder if you guys, think that it's makes sense to keep riding this given the environment, or whether this is time, if you're a crypto investor, to start locking in some gains and lightening up.
Hey, hi, Adam. Yeah, crypto is a tough one. And we've said for quite a while that it's pretty obvious the blockchain is genius and that it's here to stay, but we've had trouble deciphering what's what in crypto land. There's so many coins to follow, and it seems like it's been wrapped up in the bubble that we've been living through, but we can't deny the technical strength of Bitcoin itself, more than anything else, and really Bitcoin. And Bitcoin sitting here at $120 $120 a Bitcoin. I almost said $120 an ounce. I'm so used to talking about precious metals.
120,000, Mike, right?
120,000.
Exactly.
Yeah.
120,000. Sorry. Here's an ETF that follows Bitcoin. There's a whole bunch of these that came out in the last year, but this one happens to be, I guess, Bitwise. But Bitcoin had a nice basing out. These are patterns that we look for. Sideways consolidation, a breakout to new highs, broke out of this handle being at around 108,000 spot Bitcoin. And so we went right up to about 120, I think 126, 127, and here we are floating, building yet another, yeah, basically a flat base. These are all very positive technical aspects, is what I'm saying. And so it's impossible for me to measure Bitcoin or it's really difficult to even understand the whole concept for a lot of people for crypto. But to me, the trend is up. Technicals look good. We owned it in our model for a little bit. We got out. We got out too soon, quite frankly. But so we missed this most recent move. We're probably not going to buy it anytime soon, just because we prefer to our fallback gold, silver, and miners. But those that are in Bitcoin, I can't knock it. I just can't knock it. It's got a beautiful pattern, probably going higher. I would say the technicals should point towards a $150,000 target. If I had to guess, based on experience and the other tools that we use, probably $150,000 target. So, those that are in it are doing well. It's just you don't have to be in everything, right? And so our model is not in that right now. It's more focused in gold and silver.
And
Okay.
before we head to gold and silver, maybe I can just add a little to Mike's comments on Bitcoin. And I know this might invite some daggers from some of your viewing community, but we always want to look at all sides of the equation. And I want to share actually some work that Mike Green has done. Mike's been a guest on your channel many times, but basically he did some work, and this is right off his latest Substack feed. Correlating the price, the monthly change in price with the fund flows, essentially. Um, and what this chart basically takes away is that much of the price statistically can be explained just simply by the fund flows. One way to interpret that is to say people are chasing the hot money, and there's a at least a short-term price behavior exhibits a lot of speculative run towards what's going up. And when you add that into the context of like MicroStrategy, now known as strategy, essentially issuing preferred stock and raising capital to go and buy Bitcoin. And then you get these headlines like of copycats, this vape company. There's a lot of stuff here that, frankly, forgetting what the asset is, I think anybody that's truly objective would say this is kind of bubble-like speculative behavior that, whether you're talking tech stocks or gold or Bitcoin, this kind of behavioral markers should be taken with some caution. That's all I'm saying.
Yeah, and let me just comment on that. So, asset bubbles used to happen once a generation, sometimes even more or longer than that, because it took a long time for everybody who got so burned to kind of die off, and then for it to fall out of collective memory, and then people started making the same old mistakes over again. For a whole bunch of reasons that I'm sure we could spend hours talking about. We have gotten so involved in market interventions by central planners and financial engineering and whatnot that we now are in this weird time where we're seeing financial asset bubbles happen much more frequently than they used to in the past, right? You just mentioned a few, John, right? Dot-com bubble, housing bubble, now everything bubble. We've seen this movie before. right? As you're showing those things, we're like, hey, that's just like companies that used to slap .com at the end of their name, right? Or that's like meme stocks, not even that long ago. So there's, yes, it's hard not to look at that and say, hey, whatever the fundamental argument might be for owning Bitcoin, this does not seem to be fundamentally driven now. This seems to be like hyper speculation driven, bubble mania type driven, and it's still lives within our national consciousness. Like we saw this, we've seen it relatively. We saw it with SPACs. We saw it with houses. We saw it with .com stocks. So I get it. And look, I don't know. I'm not here to say whether Bitcoin's undervalued or overvalued. Like Mike, I don't really know how to value it per se. But I just know, like you said, John, the activity that we're kind of seeing now, we have seen this movie before, and we know how this movie ends, which is usually in some, really pretty violent price correction at some point in time because speculation just ran too far afield. So you're nodding as I'm saying all this, but
Yeah. And the purity of the genesis for Bitcoin as a form of sound money, digital gold, some call it. That pure intent is certainly resonant with the way we see things. But it's just a matter of price behavior, and the volatility itself is a reason to, if you're going to be allocated, be under out, be modest in your allocation, not all in, so to speak. And there's some provocative stuff out there. There's a book out there called Hijacking Bitcoin. I've seen some interviews on that, and our team is certainly aware of it. And it just speaks to some of the corruption of this intended purity of being a form of sound money. And all just to say is just be eyes wide open. It's not a kind of not a one way Bitcoin is bad. It's just absolutely just be careful, and nothing can be that good all the time.
well,
Right?
I think my point is now that we're seeing things that really do look like excessive speculative froth, um, now that Bitcoin has become a fair amount more mainstream and there are different ways to own it and trade it, it's actually easier to hedge the price of Bitcoin than it ever was before. So if you've got a lot of exposure there, if you're sitting on a lot of gains in Bitcoin right now, I'm not necessarily telling you to sell any of it, although of course that's the easiest way to hedge, right? It's just to take some of those gains. But they're, through ETFs and a lot of the strategies that John and Mike use there at New Harbor, you can put a hedge on there. So just in case Bitcoin goes through another price correction, you can limit your downside there, right?
That's
All right.
correct, Adam.
Yeah. Okay. All right, Mike, let's end here on the precious metals. Like I said, not having the best of weeks right now, but still their year-to-date performance is fantastic for longtime precious metals holders. What are you guys seeing right now in that sector?
There's not a whole lot new to report here, Adam. Like you said, they're having a little bit of a pullback, but there's nothing really that special going on. One thing that has happened the last couple days is the dollar has had a big bounce. Let me show you a daily chart of the dollar and show your audience a daily chart of the dollar. So you'll see as this comes up that the dollar just in the last 5 days, this is a daily chart, has gone from 97 to about 99. So the dollar's been on a big downtrend for months. This doesn't really change that downtrend. This is a normal reaction, an upward reaction. So this move in the dollar in the last week almost certainly has taken some of the wind out of the sails of the precious metals. Going to the silver chart on a daily, let me pull up an ETF that follows silver. This happens to be SLV. On a daily chart, you can see we broke out here of this triple top. This triple top represents 35 on silver, 35, 35, 35. So, and then we broke out of there. And that's when we added it to our model. We added a little piece of silver back here, 2.5%. And since then, we've been on a nice uptrend. And so all we really did here is pulled back to the 21-day moving average, which is this light green line. We have not touched the 50-day moving average yet. So there's not a lot to worry about here yet. I should say yet. Hopefully we don't have to worry. We'll see. Let's go to the weekly chart. Here's the big breakout out of that $35 level I just mentioned on silver. And then since then, we broke out. We had 3 weeks of consolidation followed by a breakout. And check this out, 3 weeks of consolidation. I don't know if that's going to be a pattern, but that's what happens in a stair step. It's a step up, sideways, step up, sideways. So we'll see. Maybe in the next month, we break up to here. which on spot silver would be something like $40 to $42 an ounce. Right now, I think we're just under $38 an ounce. Gold looks similar. Silver is more volatile. Gold on a weekly chart has been going kind of sideways since April. So it's probably driving people pretty crazy that are in gold. But all I can say is that gold has had a big move, and it needs to consume or consolidate those gains. Gold sitting here just under 3,300 is a very bullish trend still as well.
Yeah. And I would
Last
say to those folks, don't get greedy. Look at that price performance. It's done great. That's after some rough years. And you actually want this price consolidation, right, Mike? You don't want it to get too far ahead of itself that you'll see a real price drop. Consolidation gives you a chance just to kind of catch your breath and build a new foundation to then spring off of, correct?
Absolutely. This is healthy. I wouldn't be worried about this. If you're feeling overweight, if you're worried about it, okay, then sell down a little bit. And don't forget to sell on the way up either. A lot of people have been holding gold and silver for 10 or 20 or more years. That might mean that you have a very high percentage, and certainly more than the 10% or so that we recommend. It is a good thing to learn to psychologically sell on the way up. You don't want to hold this forever and never sell any. Yeah, I'm often talking to people and say, sell some, do something, buy a car, take a trip, whatever. But this gold chart is very, very bullish. If I went to the monthly, just take a look at what it did when it broke out of this $2,000 level at the beginning of last year. It's just gone straight up and sideways. So the short-term gyrations can really shake you up. If I went to silver, you see just how crazy silver can get. This is what silver did back in 2011 when it went up basically $50 an ounce. And as you can see in recent months, silver's been strong. I would expect silver and gold to continue to consolidate a little bit here. If you're not in these markets, it's a good time to enter a little bit at a time in these consolidations. But I'd expect both of them to go higher. Miners as well. And I should say that our work measures relative strength of one versus the other all the time. And right now we are seeing that miners, and here's GDX, this is a big ETF, its too is going sideways. You can see it's trading at levels that we traded at back 4 months ago, 3, 4 months ago. So don't get impatient, but still relative strength is favoring miners over bullion. And within bullion, our work favors silver over gold. So the gold silver ratio has now dropped from 104 to 84 or something. We wouldn't be surprised to see it get down towards 60 over time. We'll see. But yeah, that's the news. Miners over bullion and within bullion, silver over gold, all within respectable limits in terms of your allocation.
All right. And I just want to tie this discussion to another video that's coming out next week, which I just filmed with precious metals mining stock analyst Jeff Clark. So we went through, his current outlook on the precious metals mining sector. We then actually talked about a couple of specific companies. I think you'll like it, folks, if you're interested in the space. But, he did talk about how he thinks that the metals still have a good deal more room to run, like you think, Mike. But even if they don't, right, the prices have come up so far, so quickly, as you showed, that the profit margins at the miners are really beginning to get, pretty crazy in a good way, in terms of just dramatic increases in free cash flow, things like that, right? And so Wall Street Wall Street has ignored the precious metals mining space for a long time. But the thing that Wall Street can't ignore and loves more than anything else is profit growth and momentum. So you can make an argument that even if gold and silver go sideways for a year or more, that we could still see some further price appreciation of the mining sector complex, because as more and more of these companies start posting these really attractive free cash flow numbers, that more and more Wall Street investors who have not been in the space start to think, what, I got to start putting some money in there. And another thing that Jeff thought was going to be a big part of the next really big upcycle in this space, and he said this is the historic pattern, is when you have a bull market in general equities that starts to top out. So when you've had a great run, but you're no longer getting the gains, getting the growth in gains that you were before, then Wall Street investors start looking around for, okay, well, where's the next big upswing to put my money in, right? And if that coincides with a high in precious metals like we're in right now, that's a very natural alternative for money that's in the stock market. Or in cases like now, when the bond market is stuck at higher for longer bond yields, bond investors start saying, I'm a little bit worried bond yields could keep going higher. I might want to take some of my money out of bonds, but still put it somewhere safe. Again, precious metals is sort of the natural alternative for that. So you kind of have these two building historic patterns that suggest that there could be another big upcycle in the mining space, and it doesn't necessarily require the gold and silver prices to vault higher from here.
Yeah, I hope so, Adam. That's what our tools are telling us. We've owned these things fundamentally for a long time, but all of the technical tools are telling us that we're starting to see a lot of interest in the space. Newmont is a big bellwether. The big mining stock in the S&P 500. They came out last week with really good earnings, and the stock jumped, I think, from 60-ish to 64. It was up $3 or $4 in a day. That's a good sign. We're starting to see some mergers and acquisitions in the space. Royal Gold bought Sandstrom and one other company. So we'll see. But right now, we're consolidating sideways. And as I showed you with that chart of GDX, we've been trading at the same level for 3 or 4 months. And so we start to get a whiff of something more positive, we could break out to the next level. That's how the market often works. It breaks out, then goes sideways for a while, figures out what's going on, and then oftentimes we'll break out again. So we want to see that next step change in miners and in metals. And hopefully that happens in the next few weeks to few months.
All right. Well, gentlemen, look, we're at the end of the hour here, so I'm going to start wrapping up. John, I'm going to give you the last word here. As I like to end these monthly discussions with you guys, you guys are a great source by kind of having your finger on the pulse of what the average investor is thinking, because you have clients whose money you're managing, and a lot of thoughtful money viewers come over to you guys to have their free consultations with you. So in terms of your discussions with real people who are made up of a lot of people who watch this video, what are you hearing right now, either in terms of concerns, hopes, aspirations, goals, whatever, of the average investor right now?
Yep, I think the theme of this year, frankly, has been confusion. Not being able to make sense out of the headlines versus markets and vice versa. And that's where sometimes just pulling up a chart of data that can simply tell the reality rather than what the news headlines are saying can sometimes just be an aha moment, right? And when we bring up kind of statistics on valuations, not as a short-term timing indicator, but as a big picture. Hey, especially if you're in good shape, you don't need to be taking all the risks that the Wall Street and media machine prompts you and seduces you to take. And what does that mean? It means real impact on people's lives, hopefully. Thankfully, we've had a lot of good review calls with clients, and it's fun to hear about their summer plans, their vacation plans. It's uh, very heartwarming to hear people say that you guys, thank you for helping us get through this pretty tumultuous time in the cycle, and that's what we're here for. And every day is a new day. We're going to learn lessons and be taught lessons every day the rest of our careers. This is not something where you can just put on a program and go play golf. No, we're here watching things, getting taught, getting schooled, as they say, every day, and we're just trying to be open-eyed and objective about everything we do.
Okay. All right. Well, look, I'll talk in a moment about how folks can have one of those free consultations with you if they want. But first off, folks, if you enjoy these monthly deep dives with the New Harbor team, please let us know that, and we'll keep doing it. To show your support for that, hit the like button and then click the subscribe button below. I think this video is airing on July 31st, the last day of July. I've been trying to encourage folks to watch. If you're not subscribed to this channel yet, folks, it only takes you a second to just hit that subscribe button. Please do that. We're trying to get as many subscriptions as we can by the end of the month. It's good for you because you get alerted when new videos come out in the future. But it's very good for this channel because the more subscribers we have and the more active subscribers we have, the more love the YouTube algorithm gives this channel in sharing this video with other like-minded viewers like yourself. All right. And if you would like to get some help, if maybe you're one of those people, as John mentioned, who's just kind of confused by all the different cross currents that's going on, or maybe you want to take me up on my call to action to define your financial goals or update your financial plan, or you just want help of any stripe from a good financial quarterback, then highly recommend most of the people watching this video get that help from a good professional financial advisor, but very importantly, one that takes into account the macro issues that John and Mike have talked about in this video and that I talk about with my guests on this channel on a weekly basis. So if you're interested in that, to set up one of those free consultations, just fill out the very short form at thoughtfulmoney.com and you'll be connected with one of the endorsed advisory firms that Thoughtful Money supports. These are the firms you see with me on this channel week in and week out. And again, if you want to talk to John and Mike, that's one of the options that's there. Quick reminder, these consultations are totally free. There's no commitment to work with these firms. It's just a free service they offer to be as helpful as possible to as many people as possible. John and Mike, gentlemen, thanks again yet for another week and for another monthly recap here. I think this one was really good. And look forward to seeing you guys in 2 weeks when I get back from Ireland.
Thank you, Adam. Always a pleasure, and we feel humbled you have us on like this. And thank you to your viewers. We love feedbacks. If you have feedback for us, please share it in the comments. And hopefully, it's not all bad feedback. We hope you got something of value. And have a great trip, Adam, visiting your daughter there in Ireland.
Thanks, John.
Really nice talk, Adam. Thank you so much. We'll see you soon.
All right, boys. Thanks so much. And everybody else, thanks so much for watching.